Hello and welcome to my channel. In this video, we would be covering the topic time value of money. This video is part of NISM Investment Advisor playlist. Already many videos have been uploaded, so I request you to please go through the playlist. You can get the link to the playlist on the I button in the description box of this video as well as at the end of this video. Now, I hope that by the end of this video, there would be some value addition to your knowledge which would help you in clearing your exam as well as broadening your financial knowledge because this topic is really important. Now, let's start with this. So, the topics that we will be covering is time value of money, of course, present value and future value. We will see how inflation plays an important role in determining the value of money. We will understand the concept of compounding and discounting. Time value of money. Now, even if we just try to understand what exactly it is indicating, time value of money, it indicates that your money is holding some value in relation with the time. Okay, I'll be repeating so that this becomes clear in your mind. Your money is holding some value in relation with the time. Nowadays, it's very important because today we know that there are so many financial avenues where we can invest our money, where our money can grow with certain rate of interest for a certain time period. So the money invested today would not be the same after a certain period of time. Now let me make this clear to you with an example. So supposedly there are two persons, person A and person B. Person A is offering you 10,000 rupees today. Person B will be offering you 10,000 rupees after 1 year. What you would like, which option is better for you? Whether you would like to take 10,000 rupees today only or whether you would like to take 10,000 rupees after 1 year. So you have to decide and quickly you will be answering that 10,000 rupees at today's point of time, at today's period, as soon as possible, you want your money in the pocket. Now that's because you know that if you are having 10,000 rupees today, you can invest that money, you can grow that money at certain rate of interest. You can invest in mutual funds, you can invest in share market, in equity, debt instruments. You can also hold your money in fixed deposit, or even if you are holding your money in your saving account, you are earning 1 to 2% annually. So that is also a certain value addition. However, if you are getting the same amount of money after 1 year, which is again 10,000 rupees, so that makes no sense. So you would like to have money as soon as possible. Now, why is this happening that with time, the value of your money is degrading? Why do you want to increase the value of your money with time? So there are these two concepts which will be more clear to you once you understand the concept of inflation and the concept of investment. Okay, so let's read this sentence also. This holds true in presence of inflation, which basically refers to rise in prices of goods and services over time, decreasing the purchasing power. Now you need to understand this. Supposedly you are having rupees 1,000. The quantity of goods that you can purchase with 1,000 rupees today will not be same in future period of time. So, for example, with 1,000 rupees today, you can buy one quantity of certain good. Maybe in future the price will be increased to 1,500. So to buy one quantity of the same good in future period of time, you will have to pay 1,500. However, the good is same, the quantity is same. So why you are paying more? Now that's because the concept of inflation exists. Inflation is nothing but rise in the prices of commodities and services with time. Inflation is rise in prices of commodities and services with time. Now that's decrease your purchasing power. The quantity that you can buy today, you won't be able to buy the same quantity. You will have to pay more to buy the same quantity in future period of time. So what happened? Your purchasing power, the purchasing power of the money that you are having has decreased because of this inflation. And this inflation, it is a certain rate of interest with which the prices of goods and services are increasing. So this rate of interest could be 6 to 7%. Now if you are holding your money, maybe you are holding your money at savings, your money is not growing. So for example, you are able to save 1 lakh rupees. Now this 1 lakh rupees you are not investing, you are just saving it. So after certain period of time, after 2 years, 3 years or 5 years, whenever you want to use this money, after certain period of time, this money would be same. It means that your 1 lakh rupees would, after 5 years of time, again it would be 1 lakh rupees only. But will you be able to buy the same quantity of things or the same services you can avail today? Will you be able to avail the same service or buy the same quantity of goods in future period of time? The answer will be no. However, the value of your money is same. So saving doesn't make so sense if you are not investing it. Now supposedly you are investing your 1 lakh rupees and your 1 lakh rupees has grown with certain rate of interest, for example 10% rate of interest. So after 3 years, if the inflation rate was, inflation again I'm repeating, it is rise in prices of goods and services. So after 3 years, if the inflation rate was 6% and your money has grown by 10%, so 4% again you are in profit. Not only you have beat the inflation, you have also increased your money by 4%. So that's your actual profit. And if you are not investing, actually your money is degrading with time. So here by investing, you have saved your money and also you have been able to grow your money and get that profit out of it. Okay, so you always need to consider this. In fact, whenever you are making investment, it is always advisable that you deduct the inflation percentage, because that's how you will be able to get an idea that what exactly is the effective investment profit that you have get out of your investment. So effective profit, if you want to know that, you need to deduct the inflation rate out of the investment, out of the rate at which your investment has grew over time. Money hold at present can be invested to grow in future at certain rate of interest over a time period, thus appreciating the overall capital. Now this doesn't make any sense. It doesn't mean that I am saying your investment cannot go in losses. Obviously there can be losses in your investment, but we know that there are certain financial avenues which are safer options to invest, which provides you a certain rate of interest, and also for longer period of time through SIPs, through doing the better investments, through choosing the appropriate fund. You can overcome this risk and you can look for good returns. Any delay in investment is an opportunity lost. Now this whole concept of time value of money, few things that I would say you need to consider. So first thing is that present worth of your money is greater than the future worth of your money. Why is that? Because there is inflation available in the economy. Now this inflation is decreasing your purchasing power. How is inflation decreasing your purchasing power? Because it is increasing the prices of goods and services over time. So what you can buy now, you won't be able to buy the same quantity in future period of time because of this inflation. Now you need to beat this inflation by investment, and thus you make investment to grow your money over a period of time. So we know that money holds value in terms of time. So we can invest our money, we can grow our money, and for longer period of time we have invested our money, we would be able to avail more benefit. So thus our money is having value in terms of time, which we refer as time value of money. Now let's see this illustration. I got it from internet and this was very simple to explain, and I hope this would be useful for you to understand as well. Delay in investing can be costly. Now see, amount required if you want to have 15 lakh rupee with an expected return of 8% per annum in duration 20 years. Okay, how your time plays an important role in investment. Why you would like to have money as soon as possible. We would try to understand that with an example. So suppose you want to have this much amount of money, you expect a return percentage of 8% after 20 years. So for 20 years, the investment that you have to make per month would be approx 2,546 if you started today at present period of time. Now maybe you have delayed your investment by 3 years. Now you are left with only 17 years. Previously you were having 20 years, now you are left only with 17 years and you want the same amount of money, that is 15 lakh. So you will have to make an investment of 3,747. Now see, previously for 20 years you were required to make an investment of approx 2,500 per month. Now it's approx 3,700 per month. And in the same way, if you delay it by 5 years, you have to make investment of 3,300. If you delay it by 10 years, you have to make the investment of 8,200. Here, I think it's the wrong figure given. But anyways, this example was to illustrate you that how if you are delaying your investment, you have to pay more cost every month, because you are having the same goal set as your target. So you need to understand that concept. Now, when we talk about time value of money, two concepts are really important which you need to understand. First is future value, second is present value. So which we are going to touch upon that. Future value refers to value of money in the future after a specified period of time given the current value and the interest rate. Now the formula is future value is equal to present value 1 plus I raised to power t. Here you can see FV is representing future value, PV is representing present value, I is representing interest rate, and T is representing the time period for which you are holding your investment. Interest rate is the rate that at which your investment is going to grow with time. Present value is the money that you will be investing at today's or at the present period of time. Future value is the money that you will be getting after certain years once your investment is completed. So this concept of future value is to help you calculate. So if you want to know that how much money you would require after 3 years, if you are investing 10,000 per month, what would be the amount of money that you will be getting after 3 years if your investment has grown by 8%. So you can have a clear idea that what is your goal. Now, for example, how this concept plays an important role. So, for example, you want to buy a car. You want to buy a car after 5 years, and the car supposedly would cost you approx 15 lakhs rupee. Now you want to have an idea that if I want to accumulate 15 lakh rupees, what should be my monthly investment that I should make. And if the rate of interest that I'll be getting on my investment is 8% 8% per annum, what is the monthly investment that I'm making. So that is you trying to figure out what is the present value of money that you are investing, and your future value, you are having that estimate that 15 lakh rupee, the future value is what you require. Okay, so this is how you can try to calculate the present value, the future value, and I think this would be more simpler to understand with examples. So let me show you an example and you will understand this concept. But before that, again, we are having this concept of present value. So there is this present value is the current value of future sum of money or cash flow given at particular rate of return for a specified period of time. So in future value, we are trying to calculate the money value after certain number of years, after certain time period, what money we will be able to accumulate. Present value is we are trying to estimate that how much should I invest at today so that I can have certain sum of money in future. Okay. So here you are trying to estimate the current value to get certain sum of money in future. In future value concept, you are trying to estimate that what would be the future value of your money which you are investing right now. So both the concept plays an important role, and these are the formula. For future value, we saw that formula was present value into 1 plus rate of interest, which is I, interest rate, raised to the power t, that is time period. For present value, we are having the same formula. The only difference is we would be here dividing it. So in future value, we were multiplying present value with this 1 plus rate of interest raised to power time period. Here we are dividing future value with this 1 plus interest rate raised to power time period. Okay, so you need to understand this formula. Notations used are same. FV is representing this, PV this, I is rate of interest, and T is time period. Understand this with numerical examples. So first example is, suppose you are having rupees 1 lakh to invest in a mutual fund that will yield you an expected return of 10% after 5 years. So 1 lakh rupees you are having today, and you expect a rate of return of 10% after 5 years of time. So you want to know that what would be the future value of money that you will be getting once you reap out your investment. Once you will be redeeming your money, what will be the amount that you will be getting? You want to know that, you want to get that idea that what exactly would be the amount of money in future that you will be getting. So 1 lakh that you are investing right now is your present value. The rate of return that you are expecting your mutual fund to grow with is your interest rate, that is 10%. The number of years for which you would be holding your investment is your time period, that is 5 years. So putting into the formula, if we want to calculate the future value, we know the formula is present value into 1 plus interest rate raised to power time period. So 1 lakh multiplied by 1 plus 0.10 here is representing the interest rate, that is 10%. So 10 divided by 100, which would be in decimal 0.10, raised to power 5, because 5 is the time period and here we are computing it annually. Okay, so after 5 years, if you have invested 1 lakh rupees at 10%, you would be having 1,61,051 rupees approx. Okay, so this is your future value. By putting this formula, you can calculate what would be your investment value in future period of time. Same way, if you want to calculate the present value, so let's take this example. You want to accumulate 5 lakh in 5 years. So you are having this future goal in your mind that you want 5 lakh rupees to be with you in 5 years of time. If you can earn a rate of interest 8%, now you know that you are having a very good fund in your mind, and you know that you would get approximately 8% per annum interest by investing in that fund. So what should be the sum of money that you should invest today to get this 5 lakh after 5 years? So here you are having future value in your mind. You know that your goal is to achieve 5 lakh rupees. You know that your interest rate of the fund in which you would be investing would be approximately 8%, and you would be investing for 5 years of period. Now to calculate present value, that how much money you should invest at today's period of time. So future value divided by 1 plus interest rate raised to power t, that is time period, and putting down the values, 5 lakh divided by 1 plus 8%, 8 divided by 100 in decimal 0.08 raised to the power 5 would be giving you 3,40,291. So this is the amount that you would have to invest at present period of time to accumulate 5 lakh after 5 years, if we are assuming 8% is the per annum rate of interest. Now let's understand the concept of compounding and discounting. So compounding is exactly when we are trying to compute future value from present value. So present value we are having and we want to calculate future value. So this concept is referred as compounding, because 1 lakh rupees which we have invested at present period of time will be growing at certain rate of interest, which we know is compound rate of interest, compound interest rate. Okay, the same formula which you have read in your 12th books as well, simple interest and compound interest. So your money would be accumulating with compound interest annually, and you will be getting this future value. So this refers to the concept of compounding when you are trying to calculate future value and you are having present value in your mind, rate of interest in your mind. So compounding is happening. Now, when you are having a goal set in your mind that future value is, we took the example of 5 lakh rupees you want after 5 years of time. So you are having future value in your mind. You know the time period, the rate of interest you are having, but you want to calculate the present value, which means you are going back to the present time. So this concept is referred as discounting. The rate of interest would be used to discount your money back to the time and give you the exact figures that you would need to invest at present period of time to get certain goal that you have set in your mind in future period of time. So this is the concept of compounding and discounting. Compounding is from present value to future value. Discounting is from future value to present value. So the method used to determine the future value of present investment is known as compounding, and the method used to determine the present value of future cash flow is known as discounting. So here is the summary of what I already told you. If we invest some money today, what will be the amount of money that we are going to get at a future date? So this is what we are trying to figure out with compounding concept or future value concept. And here in present value or discounting concept, we are trying to figure out that what should be the amount we need to invest today to get specific amount in future. Here the rate that at which the future value we are estimating the future value at the rate which is referred as compound rate, and here we are trying to estimate the present value at a rate which is referred as discount rate. You know the formula is same for compounding. It is future value formula. So present value multiplied by 1 plus interest rate raised to the time period. Present value formula is future value divided by 1 plus interest rate raised to power time period. So this was all about compounding and discounting. And now you must have understand that how you can calculate the future value and the present value and get a more specific idea about your money, your investments, and thus this concept plays a very vital role. See, this can be this whole time value of money concept is much more broader, where we have to read about annuities also. We have to read about how the discounting and compounding can be done on monthly basis, quarterly basis, semi-annually basis. All these things can be covered in detail if we are going to study this time value of money chapter. For now, this was for this video, where I hope there would be clarity in understanding the basic concept of time value of money. I'll be uploading video where I'll be covering this in detail, where we would be covering the annuities and the how you can calculate quarterly, monthly, semi-annually, all those complications that are related to numericals related to time value of money in the upcoming video. So for now, I hope this video was useful in providing clarity related to time value of money concept. If you like the video, do hit like button and please do not forget to subscribe to the channel. That would be really motivating. Thank you so much for watching. Thank you all.